Good afternoon, everyone. Welcome to our webinar this afternoon on the National Budget of 2024. I think as you would have noted, this will not be your typical webinar focused on the economic impact of the budget. It's not an economic discussion by any means, but rather focusing on the legal, tax, and fiduciary aspects. Just by way of introduction, my name is Andre van Niekerk. I'm an associate at PH Attorneys, and I will be the panel moderator for today's webinar. I would like to welcome our panelists who, as you would have noted, bring a wealth of experience and expertise to our panel discussion this afternoon. First and foremost, a very special word of welcome to Katlego Tlale. He's the CEO of the CFO rather, of Letsema Consulting. Katlego, we appreciate you taking the time to join us this afternoon and to also share your insights with us. In addition to Katlego, we also have Dr. Candice Reinders, Director at PH Attorneys, Dr. Damien Vivier, Director PH Attorneys, Francois Fouchier, Director PH Consult, Tanya Strauss, Director PH Tax and Accounting, and last but not least, FCA Liebenberg is Director at PH Attorneys. We are truly honored to have all of you with us today. Just before we start, a few house rules. Kindly note to participants that your cameras and your mics will be switched off during the duration of our discussion. We will, however, allow a Q&A session at the end, and you are welcome to post any questions you may have to the panelists in the chat box. So without any further ado, let's dive right into our discussion on the national budget of 2024. So we all know we are currently in a national election year, and as anticipated, the budget didn't spring any major tax-related surprises, or well, at least not, on the surface. Instead, the emphasis was rather, and as expected, focused on South Africa's debt reduction and economic growth. Francois, to kick off as a first question, what's your perception of the budget, and do you concur that on the surface it appears to have rather little concern for the taxpayer, or is there more than meets the eye in your view?
Well, thanks, Andre. I think for a casual observer, it was quite uneventful from a tax and estate planning perspective. It was quite noticeable that there were no tax rebates or the proverbial bracket creep as we got used to it. But I think what is also worth noting is that we haven't had any increases in the abatements for estate duty and capital gains tax, and actually for a long time. I had a look. The last increase in the Section 4A abatement for estate duty was in 2007, when it increased from 2.5 million to 3.5 million. So effectively, we actually have an increase in our estate duty and capital gains tax liability, although there's been no increase in the effective rate announced. The effect of not increasing the abatements results in higher estate duty and capital gains tax liability for taxpayers. So I think, like with many things in life, it's very important to ask the right questions. So I think, and that's one of the objectives of this afternoon session, is to ask the question, what is not being said in the budget speech and what is happening behind the scenes. And we all know it's been a stated strategy of SARS on the long term to broaden the tax base, to improve tax compliance and administrative efficiency. So I think there is a lot happening behind the scenes, and I think we'll be unpacking that in a bit more detail through our discussion this afternoon.
Francois, as you said, indeed, it appears that there's a lot happening behind the scenes at government, and especially at SARS. Tanya, as there has been no change to capital gains tax or estate duty, and given that there was some expectation that a wealth tax was under consideration, how should the taxpayer interpret this, so-called silence in this regard?
Thank you, Andre. Yes, I agree 100% completely with Francois. SARS is definitely increasing individuals' effective tax rate subtly by not adjusting for inflation, which means in real terms, we all are really paying more tax. Also, a couple of years ago, high net worth individuals were impacted by the introduction of the 25% estate duty for estates exceeding 30 million. It was just at the flat 20% rate before. And they would have also seen the increases on the transfer duties payable on the higher end properties above 12 million very recently. Having said that, though, 5 years ago, the Davis Committee issued a report on the feasibility of a wealth tax in South Africa. This would have been an actual percentage based on the value of an individual's net assets. But this report confirmed what we already know, that South Africa effectively already has wealth taxes in the form of estate duties, donations tax, transfer duties, and security transfer tax and everything else. So government already has the means to tax the wealthy on their wealth. It was just not collecting enough information at the time to ensure that the wealthy was paying all their taxes. And the Commissioner calls this the compliance dividend. So our current finance minister has also been adamant that increasing taxes on this current tiny tax base was not the right answer at all. He's definitely also on board that efficiency in the tax collections would have to be improved. So even though we're not seeing an obvious increase in wealth-related taxes in the 2024 budget, we've definitely seen, we've seen how this Davis Commission report recommendations have been implemented to collect more information on the high net worth individuals and trusts, so that can ultimately lead to efficient tax collections.
Tanya, you mentioned that SARS is actively increasing their drive to efficiently collect taxes due. What measures have you specifically picked up that SARS have put in place to increase their collections? You know, specifically, if one take a look at the high net worth individuals and also the trust and related company structures of these high net worth individuals.
Thanks, Andre. Yes, so there's many. So for individuals to start with, the 2023 personal income tax returns already started requesting individuals with net assets above 50 million to start reporting personal balance sheets at market value for one. This was a specific recommendation of the Davis Committee report, not with the intent to necessarily levy a wealth tax on it, but just to highlight undeclared income. And then SARS also formed this high net worth individuals unit, whose primary focus will be to pick up undeclared income by our wealthier individuals. This will be intensified by the increase in sharing of information between institutions globally, which I think maybe Francois can elaborate on more. And then again, for trusts, we are seeing exactly the same thing. As an example, they've introduced the new IT3Ts for trusts. So that's for the trust distributions, which is very similar to the current IT3Bs and Cs we all receive from our financial institutions. This is basically just a tax certificate for income received from trusts. It's almost the same thing. So the deadline for that is September 2024, as I'm sure most of you on this call would know. And then also in this 2023 season, trusts were now forced to submit beneficial ownership reports to SARS as part of the trust income tax return. This, together with all the other latest information requests that we've been giving to them, would definitely be used to cross-check and check for misalignments. And then lastly, even for companies, this 2024 budget specifically again mentioned that companies would be required to set up systems that automatically uploads VAT information to SARS, and that's definitely coming. So for some entity types, this is very likely to happen within the next 5 years even. So it's definitely something to budget for and keep an eye on. So really, there's no way to hide from SARS. It's just becoming so much more important to be 100% compliant.
I think, Tanya, if I can maybe just link into what you were saying, I think the same principles apply in relation to offshore investments and offshore income and gains. And we all know that, we've got an extensive network of agreements between countries, the sharing of information between countries and sharing information with the tax authorities in the relevant countries. And it's done on the basis of the CRS reporting standard. So I think it's important to take note, for high net worth individuals and the associated structures, that there is no place to hide. One needs to make sure that you've got your affairs in order, and I think one needs to do your planning on the basis that the information will get shared with SARS somehow. In due course, they will collate that information, and they are creating that efficiency, so that they can apply that, to broaden the tax base and ensure effective collection of taxes, as we've said.
Thanks for your perspective on that, Tanya, and also Francois. Damien, as mentioned by Tanya, SARS has started requesting the submission of beneficial ownership registers for trusts as part of the annual tax submissions. What's the basis for this, and in your view, how will this affect individuals, trusts, and also companies?
Thanks, Andre. This is actually a very interesting topic at the moment, particularly because it's so novel. It's something new that's come in now in the last tax season that has been popping up that we've been seeing. But as Tanya and Francois mentioned previously, it all comes down to one very important consideration, and that's data, it's information. SARS wants as much information as possible in order to step up the enforcement and to know that they are dealing with everything efficiently. We're living currently in the digital age, and as living in that digital age, the currency of that digital age, is often said, is data. So everybody is after information at the moment. But before we just round back to that from the SARS perspective and their requirements for that, I think it's important to just very briefly, without getting too technical, just touch on the context from where these beneficial ownership registers actually come from. Late in 2022, new legislation was introduced in the fight against money laundering and terrorist financing. As part and parcel of South Africa's effort to try and get us off of the grey list. As we all know, we have been grey listed by this International Financial Action Task Force, signaling that we are a bit of a higher risk jurisdiction, as are several others, for doing business as far as money laundering is concerned. And for that reason, we are now attempting to get off of the grey list. And in order to do that, we have to step up not only our legislative provisions in order to bring us in line with the international standard. Very important, this is not something that's uniquely South African, particularly as Francois also mentioned earlier. This is something that is happening globally, and we are aligning ourselves to that international framework now. And also we obviously need to step up enforcement on ground level. So this legislation that came in amended several pieces of legislation, including the Trust Property Control Act and the Companies Act, now amongst other things making it a requirement for companies and trusts to draw up a beneficial ownership register, which essentially contains all of their ownership information, how benefits flow all the way back to the warm bodies eventually sitting behind that structure, particularly since these type of structures have been used a lot in the past for money laundering purposes and for tax avoidance, tax evasion, etc., and those types of purposes. So for that reason, it brings it together, as Tanya and Francois also said. The sharing of information is becoming so much more important, and this legislation actually permits the sharing of information between these regulatory bodies, both domestically and also, in terms of the bigger picture, internationally. And on that basis, they want to make sure that everybody has up-to-date information. So SARS also wants access to these beneficial ownership registers. To answer your question specifically, the people who should be most the red flags going up for this are your trusts and your companies specifically, as they have beneficial ownership structures and need to submit this compliance information. It's also very important, since these different bodies are sharing information with each other, that these trusts and companies specifically get this reporting right across the reporting to the different entities, including the Master of the High Court and the CIPC, and also then SARS, in order to avoid discrepancies, particularly since there are penalties that are now applicable, including jail time and hefty fines for trustees that are non-compliant, and then also, restrictions on doing business for companies if this has not been effectively done. So trust and companies should definitely be looking out and should be delving a little bit deeper into what this means for them. Thanks, Andre.
Yeah, Damien, it's indeed interesting new developments. Candace, further to what Damien said, how do you foresee SARS stepping up its enforcement efforts, specifically given the minimal changes to income tax in the recent budget?
Yeah, Andrea, I mean, like Francois said, it's quite clear that they're not aiming on bringing in taxes, but more, you know, beefing up their administration and their collection processes. And I mean, just from an AML perspective, like Damien said, now we can expect much more collaboration between SARS and the other regulatory authorities, such as the Master of the High Court and CRPC. And the whole purpose behind all of this is to identify discrepancies of information provided and then penalizing non-compliance. I mean, we've already seen that there's been data released suggesting that there are a disproportionate number of trusts that are actually registered with the master, but they are not registered for tax with SARS. So we can now see, you know, through these collaborative efforts that there are potentially instances of tax evasion that SARS is now going to investigate further. But Tanya also mentioned it a little bit earlier, you know, since this new AML legislation, SARS now requires BO disclosures to be submitted together with your returns. Initially, they wanted almost a similar format than what was to be lodged with the master and with the CRPC. But now it seems like there are proposals that SARS wants to receive proof that these submissions have actually been lodged with the master and with CRPC. And if you don't provide these proof, you know, this proof, then you will not be able to submit your returns. And SARS has provided some leniency until 1 April for everyone to submit their returns. But beyond this, there's no submissions will be allowed without that proof. And actually, a late submission will result in penalties. Tanya and I also had a discussion earlier this week about SARS that now, although it's always been a requirement that you have trustee resolutions with trustee resolutions for distributions, they now also require that you provide them with a trustee resolution that sets out the distributions that are going to be declared to a beneficiary in any given financial year. And this can either be done by submitting a resolution before the end of February outlining almost your estimates or the percentages that you are going to declare to your beneficiaries, and then your actual figures being submitted by the end of February. I mean, there's a myriad of reasons why SARS would now all of a sudden request that this document or this resolution actually be uploaded. But I mean, we speculate that AML and the disclosure of the flow of funds is a contributing factor to that.
Francois, you alluded to it earlier that there's a lot going on behind the scenes at government and especially SARS. As far as, you know, the dissemination of information gathered through worldwide reporting and the gathering of data is concerned, would you say that this is important for estate planning, specifically if one look at offshore structuring as part of estate planning?
I think it's become crucial to any plan and any strategy that's devised by advisors and their clients. So we're all used to considering the tax implications, the transfer of assets to the next generation, asset protection, etc., etc. But the way information will be reported and shared has become just as crucial as any of those other aspects when you consider your strategy and your planning. So just to use an example, if one think about an offshore trust, for example, the settlor of an offshore trust is a controlling person in relation to that trust. So whoever is the settlor, that will result in reporting to the jurisdiction where that settlor is tax resident. So one needs to take this into consideration. And I think one needs to think a lot about the flow of information and who will be reporting what. And I think the most important part there is to avoid any discrepancies. You don't want a mismatch of information that's communicated and shared with SARS that will result in all sorts of queries, etc. As another example, you know, we've seen over time that the use of a protector as part of an offshore trust is quite popular. A protector is also a controlling person in relation to a trust. So you need to be aware that that will result in reporting to the tax authorities and the jurisdiction where the protector is resident. So I think, Andre, suffice to say that our clients and advisors, you know, listening to this webinar, should make a big note of that. How do you structure and plan with the sharing of information in mind, and how do you manage the flow of information? And I think ultimately a lot of the success of your plan and your strategy will center around how you manage that data flow and how the reporting will take place. I think we're all familiar with the good old days. We had the secrecy with the Swiss banks, and we had numbered accounts and all that. We always maintain that any plan or strategy that's based on secrecy or the fact that information will not get known is doomed. I think that's one of the big messages and one of the big things that we see from what's going on behind the scenes, is sources really beefing up the capacity to disseminate this information and to deal with it as it comes in from across the globe. So therefore, a sound strategy or a sound plan must be based on the fact that information will be shared, and it must then obviously stand up to scrutiny.
I can maybe also just add to Francois there. So it's definitely important that your accountant also has a complete consolidated view of all your investment activities, that's locally and offshore, to ensure that nothing is missed. There's still this misperception out there that offshore investments can be accounted for by only offshore accountants, but I would highly recommend that you reach out to a local accountant to make sure that you're not missing anything from a local tax compliance point of view, because often someone in Mauritius or Guernsey, whatever, would not be privy to any of our information, obviously, and all our requests. So we often see clients who miss this and end up with significant penalties, unfortunately.
Thanks for that, for your inputs, Tanya. Francois, also for you. I think it's important, for clients to note the specific aspects, specifically if you have offshore structures in place. Candice, to take things a bit more local, has the budget dealt with any tax changes that affect local estate planning and structuring?
No, not the budget speech in itself. There's been no outright amendments proposed that affect local structuring or estate planning, which is a good thing. But I mean, like you mentioned earlier, it's also expected for an election year. No funny business. So for corporate tax, we are still on 27%. Trusts remain at a flat rate of 45%, with capital gains inclusion for both still sitting at 80%, which is quite high. But what I enjoy when it comes to the structuring rules is that it's an ever-changing landscape, and it's so important to stay abreast with the changes. So while the budget speech in itself has not addressed any of these structuring rules, there have been clues that have been left in the budget review as well as the amendment acts. There have been in the review itself, they've said that they have additional tax amendments that they propose for the upcoming legislative cycle, which was not mentioned in the budget speech in itself. Just, by way of an example, as relates to the corporate reorganization rules, it was proposed that the degrouping charge for intergroup transactions that are dealt with in Section 45 of the Income Tax Act be narrowed, albeit slightly, but narrowed nonetheless. So just for a little bit of background, currently intergroup transactions are used as a tax-neutral transfer between a group of companies, provided that the parties to that transaction remain part of the same group of companies for a period of 6 years post the date of the transaction. Now, what this degrouping charge aimed to do was to tax the transaction in the event that the transferee company ceased to form part of the same group of companies as the transferor company, or if the controlling companies or controlling group of the transferor had somehow changed. So what they're now proposing is that the degrouping charge only be triggered if the original parties, being the transferor and the transferee company to that transaction, no longer form part of the same group of companies. So that's a welcome change. Another example is the trusts that are also still heavy in the limelight. I mean, since March 2017, the transfer of wealth from a natural person to a connected trust at low interest rates or interest-free rates are now subject to potential donations tax liability. Initially, what would happen was cross-border loans were excluded from the ambit of this, we call it Section 7C. It was excluded from that ambit because that was dealt separately with the transfer pricing rules. But now the question has arisen is what happens when the arm's length price that is determined in terms of a transfer price, in terms of the transfer pricing rules, are less than the official interest rate that is required to be charged in terms of 7C. You know, what happens in that instance? So they've requested that there be there's clarity on that, so we could expect another amendment to 7C in the upcoming cycle. Another example is the new Tax Law Amendment Act that was passed in the end of 2023 is now going to require that loans that are in a foreign currency must now be converted into rands at the average exchange rate for that particular year of assessment. And if you have a loan that is in a currency that is much stronger than the rand, you could expect a higher asset in your balance sheet. So clearly SARS is still quite interested in trusts, but I mean, in short, the budget speech, there's no apparent changes, but if you look at it holistically, I believe we can expect some changes in the upcoming legislative cycle.
Candace, you specifically mentioned trusts, and we do know that trusts form part of various estate planning structures. If we look at the new reporting requirements as well as government's focus on trusts as the so-called black sheep, you know, and the growing impetus of even our courts to pierce the veil of trusts, do you still think there's a place for having trust in South Africa and having that as part of your estate planning structures?
No, well, absolutely. I mean, trusts are like companies, they're considered to be separate juristic persons. So they have, you know, through their trustees, the capabilities and the same legal powers as a natural person, obviously subject to the provisions of the trust deed. So a trust is still a perfect vehicle for asset security in respect of assets that can be ring-fenced and protected from the personal estates of a beneficiary against any claims of their creditors. Until such time, obviously, that the assets vest in their own name, unfortunately. But I mean, in addition to that, the conduit principle is still alive and well in South Africa, and that allows income and taxable gains that are distributed to the trust to, you know, be flow through to the beneficiaries and taxed in their hands, and not at you know, the flat rate 45% that trusts are that are applicable to trusts. And on top of all of that, I mean, a trust has a multi-generational aspect as a result of its potential permanent existence, which is great for wealth planning and continuity of succession. The only problem with trusts is they have been abused in the past. We've had founders who've been using them as alter egos for other illicit purposes. So the transfer of wealth at below market values has obviously caught the attention of SARS, and this has led to SARS and the government pulling the reins in on trusts. But if used correctly and for the right purpose, then you know, yes, they are still relevant. I actually think that the real question is how you should be funding these trusts. You know, given the provisions of Section 7C and other anti-avoidance provisions contained in Section 7 and the transfer pricing provisions. So I think that is the more important question, and it's quite important that the person who's going to be utilizing the trust understands, you know, a trust and and what the effects of introducing it into their structures will be. But I mean, that all being said, the right structure, with the right advice, I still believe that trusts remain pivotal in South Africa for estate planning and structuring purposes.
Andre, if I could just add onto what Candace said, I think the same applies to offshore trusts. We still find it a very well-suited vehicle to center your international planning around the trust. But as Candace has said, trusts are a little bit under the magnifying glass from a SARS perspective. And with offshore trusts, obviously, we have the advantage that we can set up the trust in a jurisdiction where the trust is not liable for tax there. And that results in a super focus on a funding mechanism from a SARS perspective. And that links back to what Candace said earlier about transfer pricing rules, Section 7C, etc. So I think it's an important takeaway for the attendees and the advisors to keep a close eye on developments and the relevant sections that apply to the taxation of the funding mechanism, and make sure that they keep abreast of that, and also make the necessary changes, when required.
Francois, to focus our shift a bit to exchange control, I didn't pick up any mention of changes to exchange control. Do you perceive this as good or bad news for South Africans, especially?
I think the good news is that we haven't seen any negative changes. So there hasn't been any restriction of exchange control. So that means South Africans are still free to externalize funds from South Africa by availing themselves of the discretionary allowance and the annual investment allowance. And I think, our view is that South Africans should make use of that opportunity, to diversify assets offshore. On the negative side, I think we were all anticipating some announcement at some stage, or even an updated circular from the Reserve Bank pertaining to the treatment of loop structures. So we know that since January 21, loop structures are now allowed, so no longer illegal. But we've seen in practice that it's been quite challenging, to structure the offshore entities acquiring assets in South Africa, mainly because of the approach that the banks have been following in, when you get to the stage where the share certificates have to be stamped non-resident. So that's a bit of a disappointment. So we're still awaiting further direction from the Reserve Bank so that we know how the banks will be dealing with that. And that has an impact on how you view your estate planning and to what extent you can actually focus more on your offshore estate planning, because it's now offshore entities is now allowed to invest back into South Africa. But we've got this challenge with the banks in terms of how we implement it in practice. But I would say overall positive. So we can still externalize funds from South Africa as we used to.
Well, Francois, we can only hope that this gets resolved as soon as possible, because, as you said, it is causing some difficulties at the moment. Tanya, to add to what Francois said, are there any other proposed changes in tax laws that might impact personal investment structures, both locally and also offshore?
The one item that we might just want to keep an eye on will be the proposal to look into the definition of an exchange item for determining exchange differences, specifically in relation to preference shares. And that again just goes back to the point that Francois made was, the financing structures are really just so important to watch out for. So at the moment, preference shares are excluded from the Section 24I definition of an exchange item, meaning any currency gains on those preference shares are not taxed in South Africa as the Act currently stands. So we might just want to keep an eye on those developments to ensure that offshore structures are optimally financed. So for now, many investors are still definitely making use of this tax benefit, which is a great one, but SARS might be closing that very soon.
Francois, a very interesting topic at the moment is the, so-called two-pot retirement system now implemented in South Africa, where basically the understanding is that your contributions will now be divided in a so-called savings pot and a retirement pot. What's your views on this, and how will this have an impact on specifically retirement planning?
Yeah, I think it's been coming for some time. There's been a lot of debate and discussion around it, and it's now finally getting implemented this year. So it will basically allow your contributions to your retirement funds to be split into the two pots, 1/3 into the savings pot, 2/3 into the retirement pot, with the advantage that you can withdraw from the savings pot prior to retirement. But I think it's very important, that we advise clients that obviously that will be taxable when they make that withdrawal from the savings pot. And it was actually quite concerning to see that the Minister of Finance is budgeting, I think it's about 5 billion that they're expecting in taxable income from the withdrawals based on this two-pot system. So that is a concern, because obviously we don't want people to be withdrawing from the retirement investments. You want to keep your investments in those retirement funds for as long as possible, so that you can get that accumulating effect on the growth, and obviously it also accrues tax-free. So I think one should just be very circumspect. I think it is good that it's there. I mean, we've seen through the COVID pandemic that people get into a position where they're in desperate need of some financial assistance. If they can alleviate that pressure from some withdrawals from the retirement funds, I think it's useful. But I think one should proceed with caution. I think there is a danger here that people can actually withdraw too much from the retirement funds.
Yeah, Francois, but indeed, it's of paramount importance that you first consult your advisor before you withdraw from that fund, just to make sure that you understand the tax implications as you alluded to. Thank you for that, Francois. Well, we now dealt with various aspects of the impact of the budget on your personal estate and personal estate planning or structuring. For a moment, I'd like us to shift our focus, towards understanding the budget's ramifications on the corporate and business landscape. I think it's important and actually imperative for us to recognize the pivotal role that businesses play in our country and in our economy specifically, and to also understand how the budget influences their strategies and growth. Katlego, as the Chief Financial Officer of Letsema, which is a business highly reliant on the investment climate and business confidence, what are your thoughts on the budget and its influence, whether it's positive or negative, for specifically in investment and investing in South Africa?
Andre, thanks for the opportunity to share some of our thoughts as Letsema. I think our initial feeling as it relates to the budget is that it was a relatively disciplined budget. There were no major surprises, exactly as the other panelists have shared. And that's certainly a risk that we were looking out for, given that it is an election year. And the opportunity potentially to expand social spending in pursuit of particular outcomes is something that we looked at. Certainly we didn't see anything that was very worrying on that front. What we have, and certainly our partners too, who invest from offshore and are partnering with us in investing in South Africa. One thing that has stood out as maybe a bit of a concern is the fact that the state has dipped into the gold and foreign exchange contingency fund. And that for us is to some extent maybe a signal that we're not dipping into the kitty to be able to address just the rapid expansion of the debt profile of the state. And the fact that with this withdrawal, there haven't necessarily been any very clear rules that have been put forward, indicating what these funds can be used for. And obviously the associated risk that it goes into consumption, and we're back 3 years from now potentially looking at withdrawing more of these funds, is certainly one area that is maybe a slightly longer term signal that's translating to some amount of concern. And what we found is with our partners who've invested into South Africa and have partnered with us here, that even at the current moment, notwithstanding a relatively disciplined budget, we're certainly seeing a bit of a wait and see approach in terms of considerations of incremental investment, to see what the outcome of the elections are, and to at that point maybe give some thought to how that potentially impacts on the investment climate going forward.
FCA, I would like to bring you in here, on the impact of the budget. If we focus specifically on the BEE space, we know that that's an important space for especially businesses in South Africa. In your view, given the importance of BEE, especially in, for example, merger and acquisition transactions, and also the role of BEE in especially public procurement as a means to drive economic empowerment, do you find the absence in the budget of any discussion about the implementation of a new centralized public procurement system, as advocated by the proposed public procurement bill, strange?
Yeah, thanks, Andre. yeah, it was quite surprising. I think it was mentioned in the budget speech briefly, but that's about where it stopped. And I think what was also mentioned in the budget speech was I think they're planning on, yeah, it's more than 900 million worth of infrastructure development over the next 3 years, which is yeah, effectively driven, will be driven by such a system if implemented. So maybe just to take one step back quickly, the public procurement bill was the public procurement bill was basically brought out, I think, in 2022. It resurfaced again, and what happened at that stage was yeah, it was now approved by the National Assembly. I think it's now the National Council of Provinces, and the whole idea with this bill is to streamline the whole public procurement system. It is a highly complex and highly controversial bill. There's a lot of enemies out there of that bill. News articles in this week, I think CISA, the master builders of South Africa, there's a lot of negative talk around this bill, and I think that maybe contributed. Yeah, my best guess is negativity in an election year, maybe not the best thing to mention in a budget, and it's also yeah, it's a complex process. So my best guess is that they probably avoided stepping on any toes with that one, and it will be interesting to watch that space going forward. What exactly is gonna happen there?
If you're staying in the BE space, what are your thoughts on the budget and the incentives, you know, that was proposed surrounding electric vehicles and renewable energy? You know, given that much of this is, you know, much of this technology obviously implies foreign partnering. How do you see these incentives and BE playing out in the marketplace?
Yeah, Andre, I think government has for a long time had to balance the whole transformation side of things with stimulating economic growth and foreign investment. So obviously with electric vehicles, we saw it with the whole solar boom. What we are seeing is government is not backing down on transformation. So yeah, there's a few examples of that. The whole Amazon establishing themselves, I think that's big for South Africa from a job creation point of view, from an economic stimulation point of view. But they had to go through a full BE process, equity equivalent program, same with Microsoft. So I think definitely I foresee that as with that, as in the past, there will definitely be yeah, with electric vehicle incentives, for example, there will definitely be a transformation angle there. There will be some conditions attached to that for multinational entities. So I think there will be opportunities for local companies, local BE investment partners, which is, yeah, I think it's quite exciting from that perspective. But yeah, I don't think it's going anywhere. And one would have to see what we are starting to see, which is quite interesting from a legal perspective. There are hints here and there that government is trying to make it easier. We've seen, I think Candace spoke earlier about the degrouping rules. I think a lot of that that whole amendment came about because of some BE transactions that impacted. So I think that has a BE flavor to it. And we've also seen in the past with SARS with some private binding rulings where, yeah, I wouldn't say a lenient approach, but definitely from a BE perspective, we have seen that some of the decisions they make tend to favor the companies almost, and it's always part of a BE transaction. So I think to a large degree, to sum it up, I think government will, transformation will remain a key issue going forward. I think the president's also mentioned he sees it as a key part of economic growth in the company, in the country. And but I think there's also from government's perspective, they do realize that they do need to come to the table a bit to make it more attractive for foreign investment, to get economic growth going in the country again.
Yeah, if I can just add on that, I've seen in transaction that our M&A team are busy with, where there is quite a big international company coming into South African space. I mean, it's IT and that, so it's a global enterprise, you know. But the Competition Commission was quite firm on the BEE stance, and like you mentioned as well, with them coming in as allowing it to be a little bit easier. You mentioned also some private binding rulings. You and I have also had conversations about allowing BEE partners to come in potentially at nominal values, and no donations tax or anything would arise from that. So yeah, I just wanted to say that I completely agree. I see it in practice, you know, on a daily.
Yeah, and Andre, if I could maybe, you know, add to that perspective, maybe specifically with an angle of, you know, attractiveness in terms of foreign investment. I certainly think when you look at the renewable energy space, you know, that's a space where the IPP office has run, you know, now seven rounds. You know, 7th round is about to be opened, and space that's attracted significant amounts of foreign investment, while still having, you know, relatively clear and well understood, you know, rules in relation to transformation. And I think the one thing that really stands out here is that there was an independent institution that was established. So there was very clear transparency, right? The rules of the game were very well articulated and now very well understood, you know, kind of running for more than a decade. And they've been consistently applied, you know, very good transparency in the outcomes that have been achieved, and a very good look through from the entire industry and market in what kinds of structures are being done, how those are being implemented, and what the playing field is. And when you have those pieces in place, you know, I do think it really is supportive still of foreign investment because everyone's playing by the exact same rules. You know, everything is out in the open, and renewable energy, I still think, and I think is very well expected, going to draw significant amounts of foreign capital, because the primary IPPs and the principals are really, you know, multinational corporations that are bringing in this capability into the country and have been partnering well for an extended period of time. But government, quite importantly, is still getting back. Each one of the rounds that we've seen has delivered, you know, better pricing in terms of energy procurement than the rounds that have preceded.
Katlego, another important aspect announced in the budget is obviously the increase in carbon tax. In your view, how will this impact the growth of renewable energy initiatives in South Africa?
Yeah, this has been, I think, an area that's been, you know, very important to follow, especially because when you look at the global context, there's been a very significant some of our markets, Europe in particular, as it relates to the carbon border adjustment mechanism, that impacts on, you know, what the pricing of our product into those markets are going to be, with a real focus on carbon intensity. So I really think what is happening at the South African perspective really is just a precursor to the exact same market forces that businesses in South Africa are going to face as their products go to market. And if this assists in driving a transition from industrial producers who export to, you know, make sure that their entire supply chains are greener and gives them a better focus on scope 1, 2, and 3 emissions, I think that's actually additive to those businesses in terms of being able to attract those markets. But it is a balancing act, a relatively important one, because, you know, kind of ground zero of where these particular taxes are being applied is in fuel. And in a country where, you know, fuel for the, you know, slightly less off part of our society is a significant part of what their kind of day-to-day costs are, you have to balance that very, very carefully to ensure that, you know, the price increases that we're seeing in fuel, which inevitably, you know, gain a lot of attention in the media, that those aren't materially impacted while still trying to balance the kind of economic objectives that you're pushing through.
And this also effective from this year is South Africa's adoption of a global minimum corporate tax. Do you think this will reshape the tax landscape for especially multinational corporations?
Yeah, no, this was probably the most significant aspect of the budget insofar that it relates to corporate tax or in an international sphere, is, you know, the implementation of the global anti-base erosion model rules, otherwise known as the globe rules. For lack of a better name. But yeah, these rules have been, South Africa voted on it around October 2021. And the aim of these rules is to prevent the exploitation of tax rules to artificially shift profits to jurisdictions that either have no tax or low tax laws. And essentially these jurisdictions had little or no activity of the multinational enterprise. To put it differently, it aims to actually subject these multinational enterprises to pay their fair share of tax in the jurisdiction in which they operate and generate their profits. And the way in which they propose doing this is imposing a global minimum tax at an effective rate of at least 15% on international enterprises with an annual revenue exceeding 750 million euros. So when the budget documentation was released, the draft global minimum tax bill was also released, and it sets out somewhat brief guideline on how South Africa intends on integrating these global model rules into our law, and how they plan on integrating it in South Africa. But they've chosen to take a military approach, and they rely extremely heavily on the current formulation of these global model rules. Meaning that if the rules change, then our laws will change together with the updates of the global rules. The bill has also proposed that this global minimum tax be introduced with effect from all financial years beginning on after 1 January 2024. And this will be done either through an income inclusion rate, which essentially determines how much of a top-up tax these multinationals should pay on profits that are generated outside of South Africa, but they have a ultimate parent enterprise that is in South Africa. Or alternatively through a domestic minimum top-up tax for multinationals that are paying less than 15% tax rate in South Africa. So I mean, this sort of adds to you know, what we're saying is that the tax is not necessarily going to be coming from you know, directly from us, but they're going to be beefing up their processes. They're going to be looking at the multinational enterprises. And I mean, they estimate that in 2026, 2027, they're going to bring in approximately 8 billion in taxes from this global minimum tax. But it will be interesting to see how the government is actually going to integrate this into our law, and how they are effectively going to enforce this tax.
Francois, just from your side, do you think and to add to what Candace said, do you think that this will have an effect on offshore structuring and specifically the continuing value of offshore centers?
Andre, we often get that question, you know, from clients. What is the future of these financial centers? But I think it's important to note that this minimum tax rate applies to multinational corporations with a turnover of more than 750 million euros per annum. So it's got a very specific application. And in general, you know, business structures that set up for SMEs and as part of estate planning strategies, etc., will not be impacted by this. So I think there's still a place, and I think we'll have these financial centers with us for a long time to come.
FCA, another important question specifically on the BEE aspect. You know, we all know that there's a dire need for skills development in South Africa, and we noted that it remains a major priority of government. And it's also important for our ability to be globally competitive. What aspects regarding training did the budget address, and, you know, which may be of relevance to the business sector?
Yeah, Andre, I think there were two notable mentions that one can highlight. I think the first one was the sunset clause on the Section 12H learnership rebate, as they call it. I think they extended that for 3 years. That sunset clause was meant to be in this year. I think the official reason given was that they still need some more time to consider the effectiveness thereof, and if it is really meeting the objective that it was designed for. In our view, on the ground, it is working. It is driving the right. It's incentivizing the right behavior by companies, corporates. There are a lot of people going on learnerships. So companies can claim tax rebates. That's the incentive. So I think that was interesting and positive in our view. A lot of those schemes, unfortunately, are also being abused quite badly, and I think that brings me to the second thing that was mentioned in the budget was on the employment tax incentive, effectively incentivizing companies to employ people who qualify as youth. And I think that the worst abuse of the rules of structures running around out there is on ETIs, on the employment tax incentive. So it was very specifically mentioned again that they will tighten up all controls, the monitoring thereof. Will be keeping a firm eye on those sort of structures floating around out there in future. So I think if you do go that route, I think it's important to get an expert involved. And there are a lot of fly-by-nights out there, and they are firmly in the SARS crosshairs from how we understand it.
FCA, it's indeed interesting, but it seems overall that it's positive from a skills development perspective. Unfortunately, with that, it appears that we have reached the end of our webinar due to time constraints. We're almost running out of time. Before we conclude, are there perhaps any final insights or thoughts from any of our panelists?
Andre, I think maybe in conclusion, I think it's clear from the discussion we've been having this afternoon that there is a lot happening behind the scenes. I think SARS is laying the foundation, and they're building on that, and they're creating this capacity and efficiency to deal with information that all of a sudden is just shared with them from all over the globe. So I think there's still time to implement diligent estate planning and tax planning strategies. I think one should plan ahead. I think one should realize that, once all of this is in place, it will be very easy for SARS to enforce compliance. And I think one shouldn't be caught off guard. I've actually seen advisors advising clients to not be too worried about the information sharing. They base that advice on the fact that they think SARS is not capable to effectively deal with it. And I think that's a very risky approach. I think that's dangerous advice. So I think it's time to speak to your advisor and to make sure that you plan ahead and make use of the opportunities while it's still available.
Yeah, Francois, I think it's important to keep in mind that one should not underestimate SARS and government. And one must also keep in mind that, as you alluded to earlier, that there's a lot happening behind the scenes. On face value, it might appear that government is not actually taking the steps, but we must keep in mind that behind the scenes, there's actually a lot taking place. With that, I'd like to conclude our session as we've reached our hour time slot. I would like to move over to any questions. You are more than welcome to post your questions in the chat box, and then I will read them out to the panelists. Also note that you are more than welcome to send any questions to us via email, and you can find our contact details on our website. I will share the details of our website shortly. Damien, perhaps whilst we're waiting for questions, Tanya and Candice, and you also mentioned earlier, that there's increasingly disclosure requirements from SARS. And then we know also that the beneficial ownership structures must be handed in at the Master of the High Court, for example, and CIPC also now have additional disclosure requirements. Interestingly enough, one must keep in mind that we as South African individuals have our right to privacy. How do these two interplay with one another? What's your views on this? Because if one take a look at it from an outsider point of view, government have increased, disclosure requirements, and we are required to disclose more and more of our personal information. What's the interplay between these two aspects.
Thanks, Andre. You raised a very important point there. Actually, this is not just a discussion, again, as most of the stuff is that's relevant to us just in South Africa. This is something that's happening globally, as we discussed earlier, about, the more and more information. Everybody wants more data. Everybody wants more information, particularly the regulatory bodies. In relation to us. And as we've said, there's beneficial ownership registers. Without going into too much detail about it today, it's a lot of extensive information about the trusts, everything relating to the trustees, the founder, all the beneficiaries, categories of beneficiaries, all the way back, including if those beneficiaries are other trusts and companies, associations, organizations, individuals. It's a lot of information that's actually being recorded in those beneficial ownership registers that we are now disclosing. As you mentioned, as South Africans, we all do have the constitutional right to privacy, and privacy is also a discussion that's very, very big on the international stage at the moment. As a fundamental human right. In South Africa, we also have the Protection of Personal Information Act, POPIA, which everybody should know about by now. It's been a major topic over the last few years, getting business processes aligned, etc. So yes, that act does protect our right to privacy as enshrined in the Constitution, and it does bring in accountability in dealing with personal information, including by public and private bodies. That being said, though, it doesn't stop the flow of personal information or prevent personal information from being shared. It rather more places, processes and requirements and restrictions and responsibilities on how that information is used. Overall, we have to balance these against each other. In terms of the Constitution, there has to be a balancing of rights. So, our right to privacy and the information we're allowed to keep private about ourselves needs to be balanced against the need by government and specifically specific government departments. It's not just all information going to government. In the legislation specifically, it authorizes which regulatory bodies are allowed to have that information and are allowed to share that information. And the bigger picture, given protecting the country from a money laundering perspective, protecting the tax base, safeguarding the economy, has to be balanced against our right to privacy. So the key there is that government requires as much information as it needs, and SARS in particular, to do what it needs to do to enforce tax compliance. And so we will have to give that personal information to them. But on the other side, they will have to keep that information safe as well in terms of the requirements of it.
I agree with you, Damien. Well, unfortunately, with that, we will have to conclude as we ran out of time. On behalf of PH Attorneys, PH Consult, PH Tax and Accounting, and the PH Group, I would like to thank each and every one of you for joining us this afternoon. I do hope that our discussion was enriching and impactful. Thank you once more to each of our panelists for making time and to provide your insights to advancing our understanding of the personal and business implications of the budget. Kindly note that, as I've mentioned earlier, should you have any further questions, please feel free to contact us. You can find our contact details on our website, which is available at www.phinc.co.za. You're more than welcome to send us an email and we will then reply to that. Thank you once again for making your time available to join us this afternoon. Have a lovely evening and goodbye.